Learning to trade interest rates, that's the topic of conversation here today on the Small Exchange live stream, and we're very happy to have you here at the Small Exchange YouTube channel. And hopefully you're going to learn a lot about trading interest rates in general, and hopefully you're going to learn a lot about this guy, our newest product, S10Y, small 10-year US Treasury Yield. That's a mouthful. I know. I like to think of it as just until we come out with more durations, if we come out with a 30-year or a 2-year or anything like that, for all intents and purposes, it's a small treasury yield. It's even, you tighten that up, it's small yield here at S10Y. It's the first product that ticks in yield. It's only right now, it's about $1,000 product size relative to traditional products in this futures space that are hundreds of thousands of dollars here. I know that ZB future right now is sitting at about $170,000. We're super excited about the sizing, the simplicity, and everything down the line. But once again, I am getting ahead of myself because I want to do a little bit of background before we get into this product and I do my whole spiel on hopefully onboarding you to trading this new product. I want to give you a background on the interest rates landscape before this, what it looked like, what interest rates might mean to you as a trader, and everything on down the line. So to me, when you're first learning about interest rates, the first thing that I think of is, okay, there's a short term, there's a medium term, and there's a long term. And that's personified in this slide here by the Fed funds interest rate, which is, if any of you have ever tuned in to one of the very exciting meetings from the FOMC, they have 10 meetings a year that happen about a month and a half apart, where the Fed chairperson comes out and they talk about the economy and where they see interest rates headed, where they see the economy headed, and they change the Fed funds rate or they don't change it. And it's a big news item for every asset class. It's actually arguably the biggest news item that comes out, more so than non-farm payrolls or anything else. What they are moving is that Fed funds, the shortest term interest rate here at the US. Now you move down the line to the medium term and you've got the 10-year interest rate, which is the most traded interest rate here in the US. And you might be able to kind of infer why that might be. The Fed funds rate, though it seems so important and so big, and it's so talked about by the members of the Fed, it doesn't move a ton, right? Like there's meetings that go by where they don't change it. So why would that interest rate future trade change too much from meeting to meeting? It doesn't. That 10-year, when you add duration, you're adding more back and forth, more uncertainty. And that 10-year there is the most traded in interest rate futures. And it's also the most, and this isn't a coincidence, it's the most quoted when you're talking about anything in your everyday life, whether it's a mortgage or student debt or anything else. This is really the benchmark, what the 10-year Treasury note interest rate is. Then you move on down the line to the 30-year Treasury bond interest rate. And you can notice that I didn't say note, or it's actually a bond, and we don't have to get into that. But yeah, the classic bond there in the 30-year, that's also a very prominent rate. And it's something that people trade probably on the retail side most often, maybe without even knowing it. If you've ever traded the TLT ETF, this is the yield that TLT ETF is coinciding with, or ZB Futures is that 30-year Treasury bond. And so short-term, medium-term, long-term, that is how I like to view these things. And we started right there, smack dab in the middle with that 10-year. That's the yield that the S10Y futures, they track. And we are absolutely looking into adding probably that 30-year piece first, and then also a short-term piece. But once again, getting ahead of myself, let's talk about how you trade these things. Because until this week, the most traded, the most used version of these rates has been Treasury futures, and they're great. That's what I came out of college trading. And after you get a handle on them, they're honestly some of the best trades. And I still, even with S10Y futures, will be using these to pairs trade and do some different things. That being said, it took me months to figure out this stuff, because look at it. Look at that y-axis. The Treasury bond futures trading right now at about 173. If I bounce back, how does that equate to a 1.63% yield? It doesn't. And so you've got this price here that using DV01, using par values and coupon payments, you can arrive at the yield. But why would I need all of those extra steps, especially from the retail side? Maybe it makes sense from the institutional side that this thing be priced in a bond price. But when I'm looking at these yields here for the 2-year, the 5-year, the 10-year, and the 30-year, why would I be trading, in theory, if we launched a 2-year future at the small exchange, why would I be trading something that's 0.16%, but it's $110 and apostrophe 12, and without frustrating people too much, that apostrophe 12 actually stands for 12/30 seconds. So it's not even like 0.12, where it's a decimal over 100. It's actually a fraction over 32 there. And yeah, you look at any of these, you need a calculator and a formula to figure out the yield from what you're pricing. So and I've done a ton of work in the past at Tasty Trade to help people to understand this, getting people to learn in yield and the thing that they read about all the time, and then having to transfer that bias and that opinion, that research, over to a price that is the inversion of that yield, the flip side there. And it was a ton of work. It was tough. It was probably one of the hardest things that I had to do in educating people on futures at Tasty Trade. And you move on to all these different prices. And, I want to highlight that high point there in March, with the pandemic really starting to kick into gear, and you're seeing fear there with everything around COVID. That's when interest rates across the board came very close to zero. And it's an interesting data point and case study right here in the moment, because you look at that point there and you see that the black line and the black y-axis there on the left, that near zero for ZB was 185. That near zero for ZN there at the same time was 140. For ZF, the 5-year, 126. And then finally there in the very beautiful pink color, in ZT, the 2-year, 0% yields was at around 110 or 111. And so that's just a great case study for me on trying to figure out what the hell these prices mean in yield. And I even remember in my past days of creating content around Treasury futures, a lot of the time people were interested in seeing, especially in March and past times when interest rates got near to zero, they were like, okay, if 10 years hit 0%, what does that equate to in terms of the 10-year Treasury prices? And I would do that. And I would do that calculation for those people to understand, okay, if you were in theory trying to bet on rates going to zero, ZN would go to price XYZ. And that would take me, not too much time, but an extra effort. And then I have to educate people on what that price is for the 2-year, the 5-year, the 10-year, and the 30-year. We stripped all of that complexity out of it and just said, hey, if you want to bet on interest rates in the 10-year going to 0%, then you just sell that rate where it lies right now and buy it back at 0%. That's when it gets there, not these prices, not 185 in ZB or 140 in ZN. You don't have to worry about those seemingly arbitrary prices. And I'll take you one step further in seemingly arbitrary prices here with ETF prices for these US interest rates, because you've got the same yields, right? The 2-year yield, the 5-year yield, the 10-year yield, and the 30-year yield. That is the thing that is essential to interest rates, is that percentage amount, not these ETF prices that, of course, they couldn't even have those equate to the futures prices. You've got a 2-year ETF, SHY. It's not very often traded, but it is that 2-year duration for treasuries. The ETF is $86.40 at the same time that the futures, if you don't mind me going back, are $110.12. I mean, it can't even be as simple as that. The futures price is looking similar to the ETFs here. And I know a lot of you trade that TLT. It's a very simple and easy treasury bond price product to trade in the ETF world. And it's just $160. Looks like, Apple or a couple of those other stocks that are priced around 100. But once again, like telling myself, okay, if I'm selling 160 in the TLT ETF, that means I have to take a second and think, okay, that means I want yields to go up. Or if I'm saying to myself, I want yields to go up and I want to buy yields, okay, I have to translate that to selling TLT. It's really a pain. And here you can see a very similar chart to that Treasury futures price chart, but it's just in the ETF world. And once again, I want to direct you to those y-axes that are just random numbers at the end of the day. And I know that in equity ETF worlds like SPY and QQQ, those values are arbitrary, and you just you can get the hang of it, right? Like if you trade TLT for a couple of weeks, okay, 170 is expensive and 160 is cheap, and you can kind of get that subconsciously in the back of your mind. But I would contend, why the hell would you use that memory space for this stuff? Let's keep it in this yield. And now I bring you to small futures relative to those interest rates. And you can see directly that 0.87% relates to $8.70. It doesn't get any simpler. If you want that thing to go from 0.87% to 0.88%, I buy it at 870. And then I sell it at 880. It's really as simple as that. And also, if you were to see this yield tick from 0.870% to 0.871%, this contract would go to $8.71, and that would be a $1 notional move. And so that's also kind of an understated part of this, the fact that it's simple, it looks like the yield, and every I guess that would technically be 1/10 of a basis point there is equivalent to $1. It's very very sleek designed here. It's exactly what you'd want it to be, want it to look like. And then you go over to the chart, and this is something that I can get down with, a yield chart that looks like the yield. And I can say, okay, there in early August, actually put in all-time lows for 10-year interest rates. And I could, at that point, say, oh, I'm going to sell this in thinking that we're going to 0%. That was the fear. We got closest to 0% in our 10-year interest rates. Or I can buy it thinking that we're going to return to normal. And you see we've bounced off of those lows. There's no translation from price to yield. There's no saying, okay, I'm hawkish or dovish, and I need to translate that to a price now and flip everything around. No, it's the yield there that you're looking at in all of your research, all of your Wall Street Journal articles and everything else, just personified as a futures price that is small for most traders. Most traders, they can try it out no matter your account size, as long as you have a few $100. We'll get to margin in a second, but it's also standard and simple. And that brings us back to the small 10-year US Treasury yield, and a little bit of background there on the past of trading rates. But now let's dive deep into this product and how you might actually trade rates. I want to go through speculating, investing, and hedging here. And before we do that, just want to call out the fact that we have 4 other products now. Now we're at a nice number of 5 products at the small exchange. We've got 2 stock products, that small stock 75 and the small technology 60. The small stock 75 is a great barometer of the stock market at large. It's got 20% energy stocks, 20% industrial, financial, materials, and technology. And then what we did with the small technology 60 that sticks is we just put that technology sector from Small Stock 75 on steroids. We did 60 technology stocks, and we broke those down by information technologies, media technologies like Twitter and Facebook, and retail technologies like Amazon and Alibaba, and we snuck a little biotechnology in there, like the Modernas and Regenerons that you're seeing move around in light of the COVID vaccine. That's an interesting product. Then we got our small metals, gold, silver, and platinum, all packaged into one clean, small, standard, simple product there with SPRE futures, SPRE, and then small US dollar, which is another one that is, I think, essential for trading right now, with US dollar making new lows that they haven't seen in the last couple of years. SFX futures is that US dollar first product, and it's against euro, sterling, Chinese renminbi, Japanese yen, Australian dollar, Canadian dollar, Mexican peso. I think I got all of them there. British pound, I think I missed. But yeah, great suite of products. Newest one here, S10Y this week. Only been trading for 3.5 trading sessions, but we're super excited about it. And let's drill a little bit further into it. Like I've already highlighted, we talked about the fractions. I alluded to dollar value of a basis point. That's at DV01. And that DV01 is used to equate treasury futures. That's what I would look at every couple of weeks to make sure that my ratios between 10 years and 30 years, ZNs and ZBs, or ZTs and ZFs, or ZFs and ZNs, and now that's just a lot of Z's, I'm sorry, but the DV01 was kind of the measure that you would use to get those ratios right. No DV01, if we launch a 30-year product that's priced in yield, it's going to be 1-to-1 with this 10-year product. If we launch a 2-year product, 1-to-1 with this 10-year product. It's simply the differential in yields, which is what you want to be trading. You don't want to trade these difference in prices and interest rates. Who cares about that? You want to say, hey, I think the 10-year yield at 1% is cheap relative to the 30-year yield at 2%. So I'm going to buy that 1% and sell the 2%. And now I've gone too far down the DV01 rabbit hole, but we got rid of all that, got rid of coupons, just yield. That's all you have to worry about here in interest rates. And this is what you're looking at relative to these other futures like ZB and ZN. It's just the mirror image, right? Like it's nothing too crazy. If you have gotten comfortable in those treasury worlds, it's not like we're basketing together a bunch of junk bonds that move differently than treasuries. No, these products, the S10Y has one component, and it is the 10-year yield. And so it is literally going to be a mirror image of ZN. We're using ZB here for the example because I think it's what most of you probably know. And you have nothing to really worry about in terms of the movement relative to actual yields. Like I said, just one component there that is reflective of the treasury price. And it's also just one component that's a small size. I know that futures efficiency is a beautiful thing. And actually, arguably, it is the most efficient and the most helpful in the interest rate world, because it's only about, on average, 1 or 2% that you have to put up in buying power or capital requirements or margin, whatever you want to think of, to trade ZT, ZF, ZN, and ZB. That being said, 1% of those products is still over $1,000 because all these products are over 100,000. And it's a really frustrating piece here. And it's especially when you think about trading that ZB or ZN, a lot of people's first place to go with interest rates as an asset class. I mean, a small movement in that market is going to cost you, $1,000, $2,000 on an intraday basis. I mean, that ZB future moves about $1,000 per day, a really hard market to go test out interest rates in. And so we said, forget all of that. We'll create a product that is designed for someone who is maybe a small trader trying to test this out. If you want to size it up, you can absolutely do that because we have some of the cheapest exchange transaction fees as well. So it's not like, oh, you're paying $1.50 in fees to trade ZB and you're paying the same here in S10Y futures. So if you wanted to scale up to your normal size and do, 5 to 10 of those S10Ys, you're going to get clipped for a bunch of, no, our fee structure is so that you can scale up without that being an inhibitor. Very cheap fees and very cheap product here to try out. We're really, really, as an exchange, built to make those barriers to entry, those blockers to you trying out interest rates or metals like we have, or currencies, trying to make those as low, as small as possible, so that you can at least get in there and say, hey, I'm going to see how this thing works. And it's only going to move, $10, $20 every couple of minutes. And it's not going to cost me that much to trade. And our ticks are super simple here. If you want to nerd out about it and think extra hard, it is a 1/10 of a basis point. Here is that penny, and it equates to $1, but you can just think of it like we talked about. If it's 1% yields, that's going to equate to $10.00. And if it goes to 1.001%, that's $1 to the upside there. You don't know how long it took me to figure out all of these tick increments here for ZB, ZN, ZF, and ZT, where you've got the 1/32 in ZB, and that equates to 31.25. You got half of a 32nd in ZN, 15.63, a quarter of a 32nd in ZF, 7.81 and a quarter, I believe. That is. ZT is actually an 1/8 of a 32nd, and that equates to 7.81. And you might say, oh, well, you messed up there because an 1/8 of a 32nd should not be the same notional value as a quarter of a 32nd in ZF. Well, they made it even more complex, and ZT is twice the notional size. So all these different things. I just went through. Forget all the last 30 seconds of what I just said, because it's no longer going to be relevant. All these different tick increments and everything else. Hopefully this is the one-stop shop for trading interest rate futures, because of this simplicity and smaller size, and because of this efficient margin that we still have here. If you want to get your smaller size and use TLT and IEF and IEI and SHY to do so, the same durations that we were just looking at, you can do that, and you can get smaller than that $100,000, $170,000 contract. But here's the thing: when you're trying to get interest rate exposure, they're going to clip you for 50 or 100% of the product when you're trading these ETF shares. You get right now an S10Y, it's about $1,000 product, and the margin is at about $150. It's very efficient while still giving you that small size, getting the futures efficiency, and no pattern day trading rules. So you don't have to worry about any of that as well. If you're trading, like we talked about, that Fed announcement, and you're saying, oh, I think yields are going higher, and you buy S10Y as opposed to selling TLT, and you get that move that you want, you get out of it and not have to worry about anyone knocking on your door saying, hey, you did something you weren't supposed to with the pattern day trading of ETF shares or stock shares. And so that efficiency and the what futures afford you still in effect with this S10Y, just smaller and easier for the everyday trader to handle. Now, I want to conclude with some uses here for the S10Y product, and all smalls are used for speculation. That's probably the number one use of any futures product with retail, is that margin being used for speculating on short-term action. But also, if you have a long-term bias, like you think yields are going back to 2% or 3% in the 10-year, very efficient on that as well. You don't have to worry about that big ZN contract, selling that and tying up a bunch of capital for a size that a product that's too big for you, or selling TLT shares and having to put up all the money that it takes to get short shares of an ETF or a stock. So great for investing as well. And then also, this is probably one of the best asset classes for hedging portfolios of stock and everything else. And you can do that in a very flexible size. So a product that's $1,000 allows you to get really specific with how much you want to hedge. If the product is ZN or ZB and you've got, $10,000, $100,000 in stock investment as low as $1,000, that product is going to be too big. You can't even use one unit of it to hedge. This is a great product for hedging as well. But let's get a little bit into that speculation. You can see here on a daily basis, this market moves about 50 cents or $50 great intraday action. The example that I'm using here is November 9th, where the market rallied up about 50 ticks or $50 and then came all the way back by the close. To me, that's a very well-sized product that moves about 50 ticks or $50 on a daily basis with the margin at $150 or $200. Great speculative size there that can still get me good returns and good movement intraday. And then you talk about interday. This market in the summer and fall of 2020 alone, several $100 moves from day to day. As you can see, that low there in early August of $5 was when we got to 50 basis points or 0.5%. The all-time low in Treasury yields bounced right off of that back to $7 or 70 basis points. Quick $200 for anyone who bought down there at those lows. Bunch of back and forth as we get back to about $10 or 1% in the yield. Gotta love that day-to-day action as well. Plenty of what we love here at the small exchange is $100 day-to-day moves. Great for speculative, and you can size that thing up if you want to take larger swings as well. And then also from the investment side here, this is something that I've been doing research on since I was at the Board of Trade, the mean reverting aspects of the yield asset class. And we've seen in the last decade an average 10-year yield of about 2% here. And so you can see we've traded up to 3%, we've traded down below 1%. And that means to me that I can have long-term biases, and you can have whatever bias you want, but if you trade price extremes or you trade mean reversion, this is a very simple product to understand. Oh, okay, the mean is $20 or 2%. All right, I'm looking for stuff that's around 1% or lower to buy, and I'm looking for stuff that's north of $25, $30 to sell. And we've got both sides of that market in the long term with all of those traits that make this an easy market to invest in or have a long-term speculative view on. And I also want to end with some of the hedging cases here for yield. You can see from this chart that yields have a pretty strong positive correlation with the stock market. You might be used to, negative correlation from bond prices. Forget all of that. Positive correlation here with stock markets and the yield. And you can see if you want to, one of the most traditional hedges for long stock portfolios is the stock bond fund. Okay. And with that stock bond fund, it's usually, it's a 70-30 or it's a 65-35 or whatever. All they do is they buy, 70% in stock and then 30% in bonds. And that creates that hedge there. And what you could do here on your own is create that portfolio or get more granular and pick your own spots. I'm long SM75 or I'm long S&P 500, and I'm feeling a little bit fearful today, in early December. I can put my hedge on now and not worry about these ETF funds, and I'm getting more efficient than those ETFs that cost 50 to 100%. And I can take that hedge off very simply as well. And it also lends to the next piece, which is, pairs trading. You've got now a great case for hedging with yields, but then also there's the opportunity in the fact that I just said these are positively correlated markets. You see SM75 or S&Ps or Russell, whatever you trade, taking off to all-time highs, which we're sitting at here, with yields still near the lows. They're off the lows, but not anywhere close to where they were when stocks were making all-time highs in 2019. So you've got a little bit of a pairs trade there. If you think that relationship is getting further exacerbated, that stocks will stay at highs or make new highs and yields, the Fed will hold them near zero, you can get on that side of the trade, or you can bet on them converging here. Man, why are stocks at all-time highs with yields not seeing any upside? Can sell stocks, buy yields, and get paid on yields moving back to those highs with stocks, or stocks seeing that downside and being hedged by the long yield. It's a great pairs trading opportunity. And I'll finish here with, something that will definitely come in the near future with small exchange products. And it'll be even simpler because it'll all be one-to-one. The correlations will be just as high as you're seeing here, which is pairs trading within the asset class. This is super exciting. Anyone who's ever heard the term knob spread, tut spread, any of that stuff. This is going to be the simplest way to trade it. Like, I'm not even being hyperbolic about this, because we've already talked to professional trading firms about the fact that they're excited to use this 10-year against other small exchange yield products for arbing and pairs trading throughout the yield curve. Until then, you're looking at these ratios, about 20 S10Ys per ZB, about 7 per 1 ZN, 3 per ZF, about 2 or 1 per ZT there. And then one S10Y contract gets you about 30 shares of TLT. The correlations across the board are as strong as you can get to that inverse. Now, remember that there is that wonkiness now that you're trading yield against price. But like I said, we'll get you a few more yields down the line. So you'll just be trading yields against yields. It's going to be beautiful. It's going to be great. Until then, look at these for your tut spreads, knob spreads, fight spreads. That was always my favorite, the 5s and 10s. You can do that with the ZF, 3 S10Ys per ZF. That's a real nice trade, but those are stories for another day. We'll dig deeper into our small stakes and everything else about the interest rate curve spreads. And that'll do it actually for our interest rate seminar here. I hope you enjoyed everything on the product and everything on interest rates in general. Remember to get out there and look for S10Y futures. Try them out, trade them, see if they work themselves into your watch list, something that might intrigue you. And we're super excited about it. It's only day 4, which is crazy. So we're expecting liquidity and volume to grow in this market. Although, maybe the volume numbers aren't in the hundreds of thousands like those ZN and ZB contracts that have been around for almost 50 years now. But I can tell you those bid and offer spreads in this market have been just a couple of pennies wide every time I go to check them. So, you don't necessarily need a big volume number when you've got a market that is that tight and that liquid in terms of the bid offer. And then also I will offer up to you the small exchange subscription. I know we've probably got a couple subscribers in the audience here, but we love this subscription here. Just for a one-time payment of $100, you get this lifetime of discounted exchange fees, market data fees. We're not charging anyone market data fees for the first year at least here, so that you can check out our products. But at some point, we're going to have to make some money. But those subscribers are going to be paying the least in market data fees on all of our products. We've added 2 products since we launched in the summertime. We're going to add even more products in Q1 and Q2 of 2021. You're going to get these reduced fees for life for just the one-time payment today at subscribers.thesmallexchange.com. And you'll get a weekly newsletter that you might say to yourself, there's free newsletters all over the place. Well, they weren't made by yours truly here, Frank Kaberna, with a ton of numbers that go into it. Thousands of data points go into our weekly newsletter every single week. And it's also got some commentary on trade ideas, but more importantly, just some advanced metrics that we boil down to making your experience trading the smalls as easy and simple, and hopefully at the end of the day, profitable as possible. So check out that subscription. That is all I have for you here today. Thanks so much for joining.